This is Scott Becker with the Becker Business Minute, the Becker Private Equity Podcast. One of the great questions posited to me by one of our producers, one of our listeners is, where does one invest with inflation rising? And here's what I'd say is that, or with inflation unclear and still rising some. So this is a great question. And it really comes back to something we talk about all the time. The most important thing as an investor is to know yourself and to know your allocation of your assets and your temperament for your asset allocation. And then to figure out within that asset allocation where you're going to put assets. So the two things you're looking at is you've got on one hand, short-term treasury yields are now the highest what they've been in a long time. So let's say you've got $1 million put away, all of a sudden risk-free, almost risk-free, you could earn 5% on that money on one-year treasuries. So that feels pretty good. That feels good until you realize, yes, it's a safe 5%, but inflation's at 6.4%. So year after year, without doing anything, you're making 5%, but in real purchasing power, you're losing 1.4%. And you're really doing a little bit worse than that because your 5% is taxed. So the downside of being straight in treasuries is that you're safe, but you're losing a little bit of purchasing power every year. The second part of that portfolio is equities. And again, I'll talk about the basic equities. For me, that's an S&P index fund. There's a lot more complicated variations out there. And we'll talk about that some as well. But the reason you want to be in equities, now what happens is if interest rates go up a lot, equities will go down because the general multiple or price to earnings ratio that stocks trade at will go in the wrong direction as interest rates go up. The flip side is equities over the long run tend to outperform treasuries and tend to do better on average than inflation. So you have to have enough of your assets in equities to try and fight inflation for the long run. The flip side is, depending on your behavioral temperament, you can't have too much of your money in equities, because if you have a ton of money in equities and they go down a lot, you might be very, very upset. So the concept is, it's a lot of studying and a lot of working with an advisor, a lot of working with quantitative tools to try and understand the balance of equities to treasuries or bonds that lead you in a spot to best sort of withstand the problems of inflation. If your money's all in cash / treasury bonds, you're just going to be losing a little bit of money each month in purchasing powers. If your money's all in equities and equities go horribly in the wrong direction, you might have had the chance of staying up with inflation, but you might have lost a lot of your principal. So the real challenge is to find that right balance between equities and treasuries or equities and bonds that suits you, that you could live with as these things have some volatility to them. And again, the concept is, it would feel very good to have $100 million in treasuries making $5 million a year. Just you sit on that and make $5 million a year without owning real estate, without owning other things. The downside is that $5 million a year is falling way behind in purchasing power to what's out there besides that. So the reality is you need some balance of equities to go with these treasury bonds to have a portfolio that can hopefully keep up with inflation, but without too much risk. Thank you for listening to the Becker Business Minute, the Becker Private Equity Podcast. Obviously, a lot more in-depth analysis by talking to your financial advisor, your financial planner. I am not in that business, so don't call me for that. I hope you enjoy this podcast. Please text me at 773-766-5322 if you'd like to get a $50 Amazon gift certificate. You have to be the first person to text me to get that gift certificate. Thank you for listening to the Becker Business Minute, the Becker Private Equity Podcast.